Welcome to my presentation, Small Business Blind Spots Solutions. I want to start off with a little exercise. Take your right hand and place it over your right eye. Now with your left eye, stare at the X. Now just lean back until the circle disappears. Again, just keep your left eye on the X and lean back until the circle disappears. Do you see that? Or should I say, do you no longer see that? That's right, you just exposed the blind spot you have in your eye. In fact, if you did that with the other eye, you would find yourself with the same problem, except that the X will disappear because you have a blind spot in both eyes. And if you really think about it, it does make sense. Now, I'm going to try to explain it in my CPA way since I'm not a doctor, but basically the information that's coming into your eyes have to get to your brain. So in the back of your eye, there's basically wires that attach from the back of your eye to your brain. And where those wires attach is where the blind spot is. Now the brain is so intelligent, what the brain does is it actually fills in that gap with what it believes is supposed to be there. So we're all walking around thinking we don't have blind spots when in fact we do. Now we also have blind spots in business, and what I'd like to do today is share several of those with you. After graduating from accounting school, I started my career at Deloitte. And the very first client that I went to as a new employee of Deloitte was Quo Vadis. Now, as part of the celebration for my first day at work, I was going to meet up with a friend from high school for dinner. So I'm at Quo Vadis. We're in this room where there's a table, there's a phone on the table, there's a manager from Deloitte, there's a partner from Deloitte, and then there's me, a brand new employee. So I want to make a great impression. Within the first 2 hours, I get a phone call. So I pick up the phone, and it's my friend Dave that I'm going to be meeting for dinner later that day. And he goes to me, "To where are you going?" And I thought he meant what restaurant were we going to go to after the workday. And so I told him. He said, no, to where are you going? At that point, I'm thinking, I got a manager staring at me. I got the partner next to me. I just want him off the phone. So I said, "Dave, what are you talking about?" And Dave said, "Quo Vadis means to where are you going?" Now that made more sense after I heard that because Quo Vadis is a company that sells calendars and date timers, things like that. And because that was the very first week of my career, I never forgot the term Quo Vadis. But over time, the meaning Quo Vadis had some different value for me because it really is part of blind spot number one. You don't have a succession plan or exit strategy. You don't have Quo Vadis. You don't know where you're headed. And that's important because if you think about it, on average, a recession happens once every 6 years. We are now in year 10 without a recession. Winter is coming. There will be another recession. And here's the issue with that. There's 12 million baby boomers that own small businesses. And of those 12 million, most of them want to be out. They want to be retired in 5 to 10 years. Now, think about all 12 million trying to get out at the same time when you also think about this statistic. Only 20 to 30% of businesses that go on the market actually sell. So you have 12 million trying to sell within the next 5 to 10 years. Only 20 to 30 sell when they're trying to, and then you might have a recession in the mix. This whole situation can become very problematic for a lot of business owners who may discover that they end up with nothing at the end. After all that hard work, after years and years of building a business, ending up with nothing. Now, one thing I've learned while teaching goals to business owners is that you have a 42% greater chance of accomplishing a goal just by writing it down. So that's the strategy I want you to take when it comes to your exit strategy or succession plan. What I want you to do is to begin writing it down. That's all. Just start there. I want you to actually put something on paper, answer these simple questions. How old will you be when you sell your business? What year will it be? How much do you plan to sell the business for? Who are the employees that will play a key role in the transition or succession plan? And who are the likely candidates to purchase it or take it over? Are they going to be some of the employees that are working there? Is it family? Is it perhaps your competitor? It's important to start to not only think about it, but just write it down. Because just like goals, when you start writing it down, what you'll discover is that it'll allow you to take action. It'll also allow you to be more mindful of opportunities that come your way every single day that maybe you're not seeing just because of the fact that you never wrote these things down in the first place. But if you start there, you might be able to build from that. And you're better off doing it now while there is no recession, while you still have time, because you do have time. As the Chinese proverb goes, the best time to plant a tree was 20 years ago. The second best time is right now. So get started. Now, as part of the services that I provide, one of the more popular ones is helping small business owners understand how to truly read their financial statements. So basically the process that I go through is simply this, is I take the most basic form of their profit and loss statement and the most basic form of their balance sheet, and I take year-to-date information and compare it to the prior year-to-date information for both the profit and loss and the balance sheet. And then what I do is I sit down with the owner for about 2 hours per month, and we review every line item of both the profit and loss and the balance sheet. Now, what invariably happens, actually very quickly, usually in the first meeting, is that the business owner, since we're looking at their financial information, even though they really don't know how to read a profit and loss or a balance sheet, they understand a lot of the lines on both because it's their company and they're in it every day. And because we are comparing one period to another period, it's easier for them to get an idea of how they're doing. So they start asking smart questions right out of the gate, first meeting. Now, when we do this for several months, as we continue to do this, they understand the value of what they're looking at and how powerful of a tool the financial statements can be to help improve your profitability and to use it for your operations, the operations side of your business. So they invariably ask for more data, more graphs, things that are going to add to the report that are going to truly be able to help them with running their business. So one day when I was going through this process with a business owner, the business owner asked me for another data point to add to the report. And I said, sure. I said, what kind of data point do you want? He said it would be great if when we're doing these reviews, we had a number that told me how much my company was worth today. And then he looked at me and he asked me, he said, how much do you think my company is worth today? Now, at that point, I'd been going through this process with him for about 6-7 months, and I understood the culture of the company and how the company was being run. So I answered his question with a question. I said, if you were to die tomorrow, would your company survive? And he immediately said no. He was wearing that like a badge of honor. He was proud of the fact that that company could not survive without him. So then I responded, well, then your company is basically worthless. And he said to me, but wait, Tony, I mean, we're looking at this report. My company generates revenue of $1.7 million. That's got to be worth something. And I said to him, not if you die. Now, what happened here was that this business owner fell victim to blind spot number 2. Your company can't scale and will die with you because you don't have an effective emergency plan. An effective emergency plan is so important because without it, you can never have a successful succession plan. You will never be able to transition. And the reason why is because if you don't have an effective emergency plan, what you're saying is that you don't have employees that are capable of running the company in your absence, even for short periods of time. So basically what you have there is a lifestyle business that will die with you. And it doesn't have to be that way. What you should be working towards is really one of two things. Either the succession plan where you're selling or transitioning out, or creating a business that can run so well without you that you could retire, or you could work a very small amount of hours and do what you truly enjoy and continue to get a paycheck for the rest of your life. Now, in order to do that, you need the effective emergency plan, and it starts with building the emergency plan team. So ask yourself, who will run the company in your absence and what roles will they fulfill? So think about the people on your team, your employees that are capable of helping you run the company in your absence. Put their names down and then describe the roles they'll play. Now, the reason why you want to do this is because eventually you're going to communicate this to the emergency plan team. You want them to understand the roles that they're playing so that everybody is clear as to what they're going to be doing in this situation. Now, of course, with your absence, there will be gaps. And I want you to be proactive. I want you to start writing down what are the gaps in your absence that nobody else can fill. Now, typically, one of the gaps is business development because the business owner is typically the best at finding new sales. But there's other gaps too that you want to think about. One of them is that they're the only contact for the insurance company, or they're the only contact for the bankers. They're the only ones who know all the passcodes, things like that. You want to begin to become proactive about the gaps because we want to start thinking about what are the best possible solutions to fill those gaps. We want to start filling those gaps today because ultimately what we want to do with the emergency plan team is we want to begin to test the plan because that's going to be the only way that we're going to be able to grow the amount of time that they're capable of running the company without you. So ask yourself this question. How long of a time frame can I leave the company today without having to handle emergency phone calls or having a pile of unfinished work on my desk due to my absence? So in other words, how long can I leave the company today before it becomes somewhat of a tire fire situation? Now, for business owners, typically a week is too much. Some of them even tell me that they can't leave for a day. Clearly, that's a lifestyle business. So we need to start increasing the time that you can be away and have a company that runs just like you were there. That's ultimately what you want to accomplish. So how do we do that? Well, we start testing it. So if you answered the previous question, and let's say you said you can't leave the company for more than 3 days before things fall apart, what you want to do is test the program by leaving for 6 days and seeing how the emergency plan team does. So basically what you would be doing is you would sit down with the team, explain what you're doing. You're testing the emergency plan. You're going to take 6 days off and you're going to test it. And you're going to tell them ahead of time, look, I understand you're going to be in situations that you've never been in before, and you're going to have to make decisions that you've never had to before. I want you to make those decisions, even if at times they're wrong. I want you to make those decisions. I understand that you're going to fail at times. What we're going to do, the whole point of this is this, we're testing the emergency plan. So when I come back in 6 days, we're going to sit down and we're going to debrief. And we're going to talk about the successes, and we're going to talk about the failures, and we're going to determine where are the gaps, and we're going to continue to fill those gaps, because that's ultimately how you're going to get to the point where you're going to have a team that can run for many, many weeks. And so then once you succeed in your 6 days, then you'll try 12 days. And you want to do this until you feel confident that you could leave for 3 straight months if you wanted to, and know that the company's going to run just as well as if you were there. Once you get to that point, Then you have an effective emergency plan. You have created that legacy equity, that foundation that you need to allow you to be able to sell the company or transition out and then kind of retire and work the number of hours you want and continue to get a paycheck for the rest of your life. So don't waste any more time. Get this done today. Fill out this template and begin the process of building that emergency plan team. As you can see in the first two blind spots, I have two templates and very simple questions. All I'm trying to do is get you from taking ideas in your mind and actually putting them down on paper. It's a very powerful thing to just put it down on paper, because what I'm hoping you'll do is that if it's on paper, there's a greater chance that you're going to start to act upon it. Back in the summer of 2010, I had LASIK surgery. And by the end of 2010, I unfortunately had the most severe dry eye that I could ever have imagined, to the point where it felt as if I were rubbing sandpaper on my eyeballs every time I would blink. Now, I tried every prescription and over-the-counter drug that was out there, and unfortunately none of them worked. In fact, some of them made it worse. And I went to many different specialists, to the point where I had a first name basis with the receptionists at a lot of these places. The brightness of light became a real problem for me, to the point where I had to drive at night with sunglasses because I couldn't handle the lights in the mirrors. My eyes were on fire. And unfortunately, during this 1-year process of not finding answers, I did discover something that none of the specialists were ever going to tell me, that there is no cure for dry eye. And unfortunately, when I realized that, I'm thinking to myself, well, if my eyes are this bad in 1 year, what's it going to be like in 2 or 3 years? I was having a hard time just getting things done, just doing my regular job as it was. I couldn't imagine what it was going to be like if it got worse. At that moment, I realized I needed to take matters into my own hands, because I was not going to get the answers from the specialist. One of the things I did notice was that humidity had to play a role with the dryness in my eyes. So I went to the store and I bought a whole bunch of hygrometers, which are instruments that measure humidity in the air, and I put them everywhere, in every room in my house, in my car, in my office, everywhere. And I put together a spreadsheet, and I tracked every 20 minutes. I tracked where I was, what I was doing, what the humidity in the air was, and I created a 1 to 10 eye dryness pain scale, 1 being I'm feeling great, 10 being my eyes are on fire. And as I began to track that, I realized that there were activities that I was performing that would actually drop the pain. And then there were other activities that I was performing that would increase the pain. And over time, as I continued to track this for a full week, what I realized was that if I were to be able to combine several of the activities that dropped the pain, that I could remain under the red line. And when I was under the red line, my eyes felt fine. And as I got better and better at it, I got to the point where I no longer had dry eye. There is no cure for dry eye, but I solved my problem, and I used my accounting skills to help solve it, because I knew that if I could collect data, then I would have information. And when I have information, I can measure, I can compare, I can recognize trends, and that allows me to take action. And once I can take action, it gives me an ability to create new habits, create good new habits, and that then changes my behaviors. And with that, positive results. Dry eye. Who would have thought you could collect data with dry eye? But now think about the data-making machine we call your business. Your business is speaking to you every day. But unfortunately, most business owners aren't listening because they fall victim to blind spot number 3. Your profits are significantly lower because you lack a basic understanding of accounting. The whole point to understanding your financial statements is to allow you to hedge as much risk as possible and to make far more informed decisions. That's what's going to improve profitability, and that's what's going to improve cash flow. in order to have reliable financial information, it's important that you have a foundation in place that allows you to ensure that all of the information that's being entered on a daily basis is being entered accurately and in the right categories. Because as they say, garbage in, garbage out. So you want to make sure that all of the information is being entered properly. And it starts with step one, that you want to have a clean chart of accounts. Now, what the chart of accounts are, they're basically the line items that you're going to see on both the balance sheet and the profit and loss statement. Now, I don't expect you to know the difference between a clean chart of accounts and a messy chart of accounts, and I certainly don't want you wasting your time on it. So what I would like you to do is to invest a little money in hiring your outside CPA, perhaps the person who's doing your tax returns, and ask them if they could come in and take a look at your chart of accounts and clean it up. And that's all you need to say. Say, I need some help with cleaning up my chart of accounts. I want to make sure it's as clean as possible because I want to rely on the accuracy of the financial statements. So then let them come in, let them review your chart of accounts, let them make suggestions on how they would clean it. They'll share it with you, they make the adjustments, and now you have a cleaner chart of accounts. And then you can focus on step two, which is timely, accurate bookkeeping. Without timely, accurate bookkeeping, then you can't have timely, accurate reporting. And then it doesn't matter if you have a clean chart of accounts. So when I'm saying what I mean by timely, accurate bookkeeping is no later than updating all of your information at least once a week. It should be daily, but at least once a week, because we want to make sure that you have all of your information timely and entered accurately so that we can then work on step three, monthly financial statement reporting. You should be looking at your financial statements every month. You shouldn't be waiting till the end of the year when it's tax time. You shouldn't be waiting even 3 months. You should be looking at your financial statements monthly, because if you find a problem, it's only 30 days old. If you wait a full year, you could have lost thousands or tens of thousands of dollars and you won't even know it. And the way that I want you to look at your financial statements is just simply this. All you have to do is look at the current year, the previous year, a dollar variance, and a percentage variance for both the income statement and the balance sheet. That's all. You don't have to fully understand either the income statement or the balance sheet if you're doing a period to period comparison. What you're going to discover is there's going to be a lot of numbers that are going to jump out at you that you will understand, and at least you can start asking questions. And I promise you, if you do that on a monthly basis, you're going to get better at reading it, and it's going to get easier. Now we can move on to step four, the proper breakout of the cost of goods sold, so that we can create a gross margin. So when you're in the process of getting help to clean your chart of accounts, one of the things that you want to make sure your CPA is helping you clean up and create is a cost of goods sold. So on the left side here, you see that there's only sales on top and all of the expenses, and then either you're going to have a net profit or a net loss. Now, what I'm suggesting is on the right side here to have those sales, but then have your cost of goods sold, the costs of the goods associated to what you sell, separated so that you can create a gross profit, also known as a gross margin, and a gross profit percentage, also known as a gross margin percentage. And then all the rest of your expenses and a bottom line. That's what you want to break out, because if you have the cost of goods sold, which are direct labor, direct material, and direct overhead. For instance, if we were a car manufacturer, the direct labor is all of the labor associated with building that car. All of the men and women that are on the floor that are actually building the car or operating the machines that are building the car. The direct material would be the steel and the engine and the steering wheel and the tires and all of the materials associated with building that car. That's the direct materials. Now there's also direct overhead, but I'm suggesting that all you do is separate direct labor and direct materials because those are easy to isolate. And now we can move on to step 5, the gross margin by class. And what I mean by gross margin by class is gross margin by major revenue source. So for instance, this carpet company that I worked with, originally they, on the left side, had their cost of goods sold broken out, and they had a gross profit percentage of 42.99%. But once they had the ability to break out their carpets by class or major revenue source, they had 3. They had a premier carpet, they had luxury carpets, and then they had standard carpets. And once they did that, they discovered that their premier carpets were returning 59.44% gross profit. And the problem with that is that the majority of their sales were coming from their luxury carpets, and that only brought in 32.78%, the lowest margin by class. Once they discovered this new information, they made small tweaks to the commission program so that the sales people would focus on selling the higher margin products first. They would focus first on selling more premier, then on standard. There were no added resources, no added people. All the company did was make small tweaks to the commission program, which allowed for small adjustments to the product mix, which ultimately created much higher profitability. Basically, what they did is achieved step 6. They maximized their margins. Again, small tweaks to the business model, small adjustments to the product mix, greater profitability. And then they took it one step further and started maximizing their most scarce resource by improving labor efficiency. And so basically what they did is they started breaking down the gross profit percentage by their most scarce resource, which was labor, to determine the gross margin per labor hour. And what they discovered is that the premier carpet was bringing a gross margin per labor hour of $10.17, but then they realized that the standard carpet, which was less labor intensive, was bringing in a gross margin per labor hour of $10.57. So once again, they tweaked the commission program so that then the salespeople would focus more on selling standard carpets first, then premier carpets, then luxury carpets. And that's how you unlock your treasure trove. But you have to remember that you need to have the proper foundation. You need the clean chart of accounts, the timely accurate bookkeeping, the monthly financial statement reporting, and the proper breakout of cost of goods sold to create your gross margin. If you don't have those 4 steps, then you're still locked. You're still not able to open up that treasure that you're going to get when you break out your gross margin by class and then maximize your margins and then ultimately get to the point where you could take advantage of your most scarce resource and have greater labor efficiency. During 1987, Paul O'Neill was hired as the new CEO of Alcoa. And 2 months into his new term as CEO, he had the opportunity to share his vision with all of the shareholders during the shareholders meeting. So when Paul O'Neill got up there, he talked about one topic and one topic only: safety. He said that he wanted Alcoa to be the safest company in the world. Now, as you may know, Alcoa is a metals company, and they're dealing with hot metals and sharp metals and large machinery, and there's people coming going in the plants all over the place. And even though Alcoa had pretty good safety standards up to that point, he wanted to improve them where there were literally no injuries of any kind in any of the plants anywhere around the world. Now, when he was done with his 1-hour speech and was ready to take questions, there were a lot of questions from the shareholders, especially the representatives of the brokerage firms that were holding millions of shares of Alcoa. The reason why he was hired as CEO in the first place is because Alcoa was losing money, their revenues were dropping, their margins were dropping, and they were in trouble. So when the representatives of the brokerage firm started asking questions of him about how is he going to improve the sales, how is he going to improve the margins, how is he going to improve the profitability, Paul O'Neill answered every question the same way. He said, well, what we're going to do is improve safety, because safety is so important to everything else in the company. And by the time the question and answer series was over, several of the representatives ran out of the room, got on their phone, called the brokerage houses, and said, sell everything. This guy's nuts. Now, 1 year later, just 1 year later, after he was hired, Alcoa had the highest profits that they had ever had in the history of Alcoa. Now, if you were one of the lucky ones that decided to buy the shares when he was hired, and if you held it until he retired in the year 2000, you would have doubled your money on dividends alone. And then you would have multiplied the value of what you invested 6 or 7 times over because the stock had increased that much. Now, one of the reasons why Paul O'Neill became so successful so quickly at Alcoa is because he understood blind spot number 4, that all of your biggest problems can be solved using key performance indicators or KPIs. Paul O'Neill knew that safety was a powerful KPI. Now, you may have just discovered this is a blind spot, so creating effective KPIs the way that Paul O'Neill did are not going to be as easy for you. So I thought I would share 4 rules for effective KPIs. The first one is it has to be under the employee's control. If it's not under the employee's control, then the employee will not understand or see the connection between what they're doing and how it's affecting the profitability. And that's why it's always a bad idea to give a bonus or an incentive on the bottom line. The employees don't understand how that bottom line is created. So either at the end of the year, they get a bonus or they don't. And they have no idea and no control over it. So it has to be under the employee's control. It needs to be measurable by the employee as well. So not only does it need to be in their control, but you want to make sure it's measurable so that they have an idea of how well they're doing during the year as they're working towards whatever that incentive happens to be. And then they need to be leading indicators. I'll get a little deeper into that, but Paul O'Neill understood the idea of having a leading indicator KPI versus a lagging indicator KPI, and understood that safety was truly a leading indicator. And then it needs to be congruent with the company goals and strategy. Whatever direction you want to take the company, that's ultimately what you have to keep in mind when putting the KPIs together, because every KPI should play into whatever direction you're trying to go with the company. Now, I just recently gone through this process with a company that added a new product line to their business, a water filtration system to their business. And sitting down with the salespeople and the managers, I asked them as a group what they thought would be a good key performance indicator for this water filtration system. And the first thing that they said was revenue or sales. They thought that sales would be a great KPI. So I explained to them the difference between a leading indicator and a lagging indicator, and I kind of explained it by asking this question: how do we generate revenue? So basically, I wanted to know what precedes revenue. What do you need to do in order to create that revenue or those sales? And they said visits. The more visits we have, the more sales we're going to make. And I said, great. What precedes visits? What do you need to do to create more visits? And they said leads. Leads will create more visits, which creates more revenue. I asked that again, and they said follow-ups. The more follow-ups, the more leads, the more visits, the more revenue. And then I asked again, and they said contact. Now, when I asked it again, they mentioned things like how if the company were to improve the website, it would allow them to get more contacts. At that point, it was out of their control, so we focused on contacts. And as you can see, the items at the bottom of the screen are the leading indicators. They're the more effective KPIs, and the items on the top of the screen are the lagging indicators. They're less effective KPIs. They're more results of the KPIs. And that is what you want to do, is try to focus on finding the more leading indicators. Now, if this is the very first time you've tried this process, then more than likely you're not going to get to the most leading indicator. And that's okay. What you want to do is go with whatever you determine is the most leading indicator. For instance, if you went through this process with this example and you decided that leads was your most leading indicator, then start there. That's okay. Start tracking leads. And what you'll discover over time now that you're tracking it is that there is something that precedes leads. You'll figure out that follow-ups precede leads and that you should be tracking follow-ups. And then over time, you're going to figure out that contacts precede follow-ups. You're eventually going to get to the most leading indicator just by getting started. So that's what I suggest you do. And the best part of having the whole team involved is that you already have buy-in and you already have greater communication. So it's a lot easier to set up the program to start tracking the KPIs and then to make everybody accountable for it. And then once again, it's in their control and it's easier for them to understand the connection between what they're doing and how they're going to get paid. Now, as part of his safety program, Paul O'Neill traveled throughout the world to visit every Alcoa site, and he did the same thing everywhere he went. He had the managers on stage, and he had the employees in the audience. He turned his back to the audience, and he looked at the managers, and he said, safety is the highest priority, and it is your obligation as a manager that if any employee comes to you with a safety concern, that you're addressing it. And then he turned to the audience, and on screen he put his cell phone number, and he said to the audience, any manager does not properly address your safety concern, I want you to personally call me. Now that was a powerful moment because that was proof that Paul O'Neill was very serious about safety. It was also proof that he truly cared about the employees. So these employees called him when there was a safety concern. But they also called him about other issues. And so not only did it give Paul O'Neill the opportunity to truly improve safety to an incredible rate, but it gave him the opportunity to fix up a whole lot of other problems that he wasn't even aware of. So I want you to do the same thing. I want you to go to your employees and find out where the most significant problems are. So this template that I'm giving you here is to be given to all of your employees and have them fill them out, because they're the ones that are going to tell you where the problems are, and they're the ones, many of them already have ideas, good ideas for solutions. This is ultimately how you're going to create the most successful KPIs, because they're going to be addressing the biggest problems. So again, give this to your employees, have them answer these questions. What are the 3 most significant problems in the company that need to be resolved to make the company more efficient? If you were in charge of the company and could make all the decisions, how would you fix these problems? And then what would be a good measurement to track that proves we are fixing your most important problem? Don't ever forget that your employees are closer to the problems than you. So it's important to ask them these questions. And ultimately, this is what's going to lead to the greatest KPIs. Because if you're working on fixing the biggest problems, then you're working towards the most leading KPIs. And then there's blind spot number 5. You think increasing sales is the fastest and easiest way to solve your cash problems. Well, let me show you a smarter way. It's called the NICE rule, the net income effect by cutting expenses rule. It takes $16 of additional revenue in the average small business to increase profit by $1. However, in a company with inefficient systems, and believe me, every company has inefficient systems, it takes $1 of cutting costs to increase profit by a dollar. So here's a very simple income statement. You have revenue of $800,000, we have cost of goods sold of $500,000, a gross profit of $300,000, SG&A, which is sales, general, and administrative expense, of $252,000, giving us a net income of $48,000. Now let's assume we want to increase our net income by $1. We would have to increase sales $16 because of the fact that we're going to have additional costs associated with that product or service that we're selling. So by the time those costs trickle down, we have our additional dollar to net income. But let's just assume in our inefficient system, we find a way to save a dollar in our SG&A expense. We end up with that same increase in net income of a dollar. So let's expand this a little bit. Let's assume I want to increase my net income by $1,800. I would have to increase my revenue, my sales. I would have to find new sales of $30,000, and by the time all the expenses associated with those new sales trickle down, I have my additional $1,800. So instead of a net income of $48,000, I have $49,800. Now let's assume that I can find $1,800 of savings within my inefficiently run company. I could end up with the same net income of $49,800 without increasing revenue a dollar. One of my clients went through this process and they very quickly discovered that they had a lot of inefficiencies because they weren't looking at their expenses regularly enough. And when they started looking at their expenses on a regular basis, they began to make adjustments. They switched cellular services, saving $872 a year. They switched banks, saving $1,209. Now here's an example from one of my clients who went through this process. They quickly discovered that they had a lot of inefficiencies, and when they started reviewing their expenses in more detail, they started making adjustments. They switched their cellular service. They switched banks. They made a phone call to the uniform cleaning vendor and told that vendor that they were going to have to price it out to other vendors if that uniform cleaning vendor didn't make an adjustment. That 5-minute phone call saved them 25%. Those 3 items alone saved $4,205, which went right to the bottom line. Now, in order for them to do that by increasing sales, they would have had to have found $70,083 of new sales. Now, this company is a very stable company, and it's extremely hard for them to find new business. It would have been almost impossible to find that $70,000, but it was very easy for them to find those savings within the company because they weren't looking for the savings. And they did this by following the uncle approach, which is basically taking 1 year's worth of all of your expense transactions and reviewing them and putting either a U, an N, a C, an L, or an E next to every expense line item. So there's an easier and more efficient way to do it, but essentially the companies are looking at every expense line item that they've incurred for the last year and placing either a U, an N, a C, an L, or an E next to it. So they're placing a U next to it if they need to understand better who the vendor is. There are a lot of vendors that you're spending your company's money on, and I guarantee there's some vendors out there that you're not familiar with. It's a good idea to know every vendor, to at least understand who that vendor is, just to make sure. So any vendor you're not familiar with, you put a U next to because you want to find out who that vendor is and what you're spending your money on. And N is to negotiate improved pricing. So basically what you're doing there is any commodity type expense, like in the example I shared with you, the uniform cleaning, you want to negotiate those improved pricing because it's very easy to find another vendor. And usually what they'll do is similar to the example, they'll just bring the price down because they know that they will lose the business and they don't want to do it because it's a commodity type of expense. C, cut the expense. It is very easy to buy those monthly recurring memberships, and it's even easier to forget that you bought them. So you want to make sure you're reviewing those expenses all the time. Any expense that you feel you should be cutting, put a C next to. L, leave it as is. There's a lot of expenses out there that you're familiar with and that you know you need. Place an L, leave it as is. E, evaluate during the next review. So there's a lot of expenses that you're investing in today and that you're not sure if a year from now it's going to be worth it. Those are the ones you want to put an E next to because next year, when you go through this process again, you review the E's first. Now, as always, I have a template that explains how to calculate your niece as well as how to go through the process of the uncle system, as well as how to follow the uncle formula so that it's as easy as possible to review all of your expenses in a reasonable amount of time. Now, there are 3 other blind spots. Blind spot number 6, you're conflict averse and retaining employees you should have fired a long time ago. Blind spot number 7, you overpay and overhire because you significantly underutilize your employees. And blind spot number 8, you have hours of available time. Believe me, you do. But you're too busy to notice. Now, all 8 of the blind spots are in my book, Small Business Blind Spot Solutions. If you are interested in supporting me, that would be greatly appreciated. I will sign it for you. I will send it to you, and I would be happy for you to have it. If you find that this doesn't give you the value, I will be more than happy to take it back and give you your money back. But I believe you'll discover that this will give you a great return on your investment. So once again, thank you very much. I hope you enjoyed this presentation, and I'd love to hear from you if you have any questions or concerns. Have a great day.